This video covers the mechanics of how we write off a bad debt and how we recover a bad debt. First, let's see what happens when we determine that a specific customer will not be able to pay the amount owed. Regardless of which of the estimation methods we use to estimate the allowance and bad debt expense, the accounting is the same when we learn that a specific customer will not be able to pay the amount owed. When using the allowance method, we write off an uncollectible account to the allowance for doubtful accounts. The entry only touches balance sheet accounts, removes the receivable, and reduces the allowance account. Assume that Barton determines that Martin's $300 account receivable is uncollectible. What entry would Barton make? Barton would debit the allowance for doubtful accounts and credit accounts receivable. Notice that because we know the specific customer involved, the customer is identified in this transaction so that we can make the proper entry in the customer's accounts receivable subsidiary ledger. Also note that writing off an account may make the allowance balance a debit, which indicates that more has been written off against the allowance than what was expected. Periodically, companies review the balance in the allowance to make certain it reflects an accurate estimate of uncollectible accounts residing in accounts receivable. I'd like to pause for a moment to make a point about how the matching principle works so nicely using the allowance method. Consider Barton Company balances in accounts receivable and the allowance that we used in the example on the last slide. Under the allowance method, the write-off of bad debts does not affect the realizable value of accounts receivable. That's how much cash we expect to collect. Neither total assets nor net income is affected by the write-off of a specific customer account. Instead, both assets and net income are affected in the period when bad debt expense is estimated and recorded with an adjusting entry. Well, what might happen if the bad customer shows up and pays, you ask? If the written off account customer shows up and wants to pay after all, you simply reverse the original write-off and record the collection. In short, reverse and collect. 2 entries. Since Barton had previously written off Martin's accounts receivable, the first entry is required to reverse the write-off and to reestablish Martin's accounts receivable. This entry includes a debit to accounts receivable and a credit to the allowance for doubtful accounts. The second entry is a debit to cash and a credit to accounts receivable for the amount of cash received. And you should know how to do that because of all the practice you've had. And finally, a summary of the methods for your review is presented here and in your textbook. That's it for accounts receivable. Now we need to talk about notes receivable. See you shortly.